Today, we're going to break down the fundamentals of mergers and acquisitions. We're going to look at what they are, why they happen, and what they mean for the market.
So, here's our roadmap. We'll start with the difference between a merger and an acquisition. Then we'll get into the main goal, which is synergy. I'll walk you through a simple analogy, cover the two main strategies companies use, and finally, we'll look at how all of this affects stock prices.
All right, let's dive right into our first section, telling a merger apart from an acquisition.
So, first things first, these two terms get thrown around a lot, but they are not the same thing. A merger is like a marriage of equals. You have two companies, usually about the same size, that agree to combine and form a totally new company. An acquisition, on the other hand, is a buyout. It's when a bigger company comes in and just purchases a smaller one, which then gets folded into the larger operation. One's a partnership, the other's a takeover. Okay, so now you know the what. Let's talk about the why. What's the real motivation here?
The one word you have to understand in M&A is synergy. It's the whole reason these deals happen. The core idea is that by combining two companies, the new single company will be more valuable and perform better than the two companies could have on their own. You're hoping to unlock new value by cutting costs, boosting revenue, and just becoming a stronger force in the market.
And really, it all boils down to this simple but incredibly powerful idea. 1 + 1 = 3. The whole is greater than the sum of its parts. That's the goal. That's synergy. Now, I know synergy can sound a bit like corporate jargon, so let's make it really tangible with a simple analogy.
Okay, imagine you've got a local coffee shop. Let's call it Shop A. They make absolutely fantastic coffee, best in town, but their food options are, well, pretty terrible. This really limits how much they can make.
Then, right down the street, you've got Shop B, a bakery. Their pastries are incredible, but their coffee is just plain bad. So you see, each one has a major strength that happens to be the other's biggest weakness.
So what happens if they merge? Suddenly you have a single shop that offers top-tier coffee and top-tier pastries. The coffee lovers start buying pastries, the pastry lovers start buying coffee. They've eliminated their weaknesses, combined their strengths, and created a much more profitable business. That is synergy in action.
All right, so how do companies actually apply this idea of synergy in the real world? Well, it usually falls into one of two core strategies.
The first is called horizontal integration. Think of this as buying your rival. Two companies in the same industry, direct competitors, combine. The goal is pretty straightforward. Get bigger, grab more market share, and, well, get rid of some of the competition. The other strategy is vertical integration. This is different. This is when a company buys another company that's part of its supply chain, maybe its main supplier or its distributor. The goal here isn't to eliminate a competitor, but to control the production process, lock in costs, and make sure your supply line is secure.
And finally, let's get to the part many investors focus on. What happens to the stock price when one of these deals is announced?
So when one company wants to acquire another, they can't just pay the current stock price. Why? Because no one would sell. They have to offer a price that's above the current market value to entice shareholders. This extra amount they pay is called the acquisition premium.
So naturally, the moment an acquisition is announced, the stock price of the target company, the one being bought, almost always shoots up to match that higher offer price from the acquirer.
But here's the flip side. The stock of the company doing the buying often goes down, at least initially. Why? Because the market can get a little nervous. Investors might worry that the company is overpaying, taking on too much debt, or that the process of combining the two companies will be a lot harder than it looks.
So at the end of the day, M&A is one of the most powerful tools in the corporate playbook. It's a fundamental way for companies to grow, create value, and really cement their dominance in the market. Subscribe to Stick Market for more informative content.